Good afternoon, students. I'm going to start now the recording since I figured out that the recording hasn't started. For that reason, I'm going to make a new recordings for you for this chapter 2 from the lectures this morning. So I'm going to share the screen and going to go quickly over the slides before I go to the Excel spreadsheet, which is the most important for you. Now, the Accounting Standard Board, as I said in the lecture, that's the bodies that govern the rules and provide the guidelines for preparation of financial statements. We have two bodies. One is the international body, the other one is the domestic. International financial reporting standards are one who are guided, required for the public corporation. Accounting standard for the private enterprises are the one who are required for the private corporations. International Financial Reporting Standard Board is the one who set up the standards for the International Financial Reporting Standards. Canadian Accounting Standard Board is the one who dealing with the Canadian standards. There's conceptual framework which outlines the main characteristics and concepts which are implemented in creation of the accounting standards. Conceptual framework, you should interpret it as a foundation for the accounting. Everything that you need to know as a principles, as objective, as a concept is in that conceptual framework. Development of conceptual framework is through accounting standards, International Accounting Standard Board and Accounting Standard Board, which is either Canadian or International Financial Reporting Standards. Why we need those framework? To assist corporation in developing financial reporting standards, to assist the accountants to determine how to account or how to interpret some transaction and phenomena which happen in the company, and also help the users to understand financial statements. The following are the characteristics that financial reports need to have in order to meet the objectives and requirements of the International Financial Reporting Standards and Accounting Standard for the private enterprises. So there's a few key characteristics that financial reports have to have. One is to be relevant. Second, to be faithful, to have a faithful representation. Relevant means to have predictable value, or through the numbers of the financial statements, when we're comparing one year with another year, we to be able to predict what's going to happen. Confirmatory value is the value that we have, which was confirmed by the people who created the financial reporting standards, financial reports for the company, people who check their work, and people who did the audit. So they confirm the value, everything is correct. Next one is the materiality. As I said in the class, materiality is something very unique. It's materiality, you should look at the level of the mistakes, which is going to change normal behavior of the users. For example, if you go back home and find out that you lost $5 on the street, most likely you're still going to sleep. So that means $5 is not material amount for you. But if you go home and find out that you lost $500, maybe that's going to change your normal behavior and you're not going to have a good sleep. So for that reason, we're going to say the $500 is a material amount. We're going for the faithful presentation. And the faithful presentation, in order to say the financial statements have faithful presentation, they have to have completeness. That means all the transactions which are related to that particular entity are recorded in the financial statement. The other thing is you cannot mix personal expenses with the company expenses, and to record the personal expenses as part of the business expenses. Next thing, information has to be neutral. Neutral means to faithfully represent what's exactly happen in the company. And the last one is to be free of errors. Another characteristic is comparability. Comparability means that we can compare one set of reports with another set of reports of different companies. Verifiability means that all the transaction was verified and confirmed that they actually happened and they're recorded in the proper way in the financial statements. Timeliness means that the financial statements has to be released on time, so creditors and lenders and investors to make decisions on a time basis. Understandability means that financial statements have the information has to be presented in a way that the normal person with enough understanding about the accounting phenomena can understand and interpret the financial statements. The last thing, the only constraint that the financial statement has is the cost. Yes, we can achieve all those characteristics. The question is on what cost? Going concern is assumption when the financial statements are normally prepared under the going concern concept assumption. What that means, that we're assuming that the corporation or company is going to continue operating in foreseeable future. If we find out that the company has a problem and most likely it's going to bankrupt, then we're not applying going concern. We're applying something else. But the going concern basis assumption is that we assuming that the company is going to continue working in foreseeable future. Cash versus accrual basis accounting. Now there are two types of events that happen. One event is when the cash is exchanged. The other event is when transaction happen. In the cash basis accounting, we're assuming that event happen when the cash is exchanged. For example, you're paying for the insurance for the car. As soon as you pay for the insurance on the car, we're assuming that all the insurance has been paid and used. For the revenue, as soon as we receive the money, regardless if we provide a service or not, we're assuming that everything is provided, everything is satisfied revenue, and we're recording the revenue. Now, under the accrual basis accounting, we're ignoring the cash. Once the cash is paid or received, that's not the point that trigger, or that's not the event that triggers the transaction or triggering the recording of the event. We're recording events only and only when certain criteria are satisfied. For example, for the revenue, when the revenue is earned, not when the revenue is collected. Simple example will be, again, we can go with your rent, monthly rent fee. So you're paying the rent before the beginning of the month. That's what landlord wants. But the question is, once they get the money, can they record those money as a revenue? Now, the fact that they receive the cash, it doesn't mean that they provide the service. Because on the first of the month, you can say, I'm sorry, I'm canceling. Can I have my money back? And they have to give you the money back. Same thing with when you're paying for the courses in the university. You're paying it away before the service is provided. For that reason, once you pay, first week of the course, if you don't like the course, you can withdraw the course and you have 100% refund. Why? Because the revenue, the service hasn't been provided yet. When this money, which university or landlord can record as a revenue, when the service is provided. Once the service is provided, We can say, yes, this is a revenue now. Why can't I record it? Same is applicable for expenses. The fact that you pay the insurance and give the cash to the insurance company, it doesn't mean that you can expense those money right away. In the contrary, since you haven't received the service, you're going to keep those money as a prepaid expense, as we're going to see later. And that will be a liability in the hands of the insurance company. Because at any point you can decide to cancel your insurance and they have a responsibility to give you the money back. When we can recognize the revenue, there's a 5-step process to determine when the revenue should be recognized in the financial statements based on the International Financial Reporting Standards. We're not going to spend too much time on the revenue recognition. The point here is you to understand that we should recognize revenue when it is actually earned. What means is the company who provide the service or deliver the goods has satisfied the performance obligation in the contract by providing those goods or the services to the customer. Once this is done, then the company who received the cash can, or provide the services, can recognize the revenue. Basic accounting equation, as we saw in the class, basic accounting equation including assets to be equal to liability plus the shareholders' equity. In other terms, the assets that you have in the company, they come in either from the liability, either from the money that you borrow, either from the money that have been invested in the company. Under the equity section, shareholders' equity, we have a separate section which is called retained earnings. Retained earnings is the amount that you're keeping in the company. The question is which amount you're going to keep. The one that you earn during the period. Within the period, you're going to have the revenue and expenses. Once the revenue exceeds the expenses, you're going to have income. Company generate income. That income is going to be transferred to the retained earnings. Why earnings? Because you earn the money first, and second, you retain it in the company. Retain means keep. Earn means revenue is higher than expenses. As long as revenue is higher than expenses, you earn something. The fact that you keep it in the company, that means retain earnings. Now, once the shareholders figure out, hey, there's a income in the company, we want the money. Then the only way you can give them to the shareholders is through dividend. And since you're giving them dividend based on the income that the company earned, that dividend is going to reduce the retained earnings which are kept in the company. We already saw that through one Excel spreadsheet. Let me show you the Excel spreadsheet again. Having problem to find this Excel spreadsheet. Here it is. So again, asset, basic accounting equation, is equal to liability and equity. From the accounting equation, we're going to see that during the period, every year, company is going to generate revenue and it's going to have expenses. Well, as long as the revenue are higher than the expenses, company is going to generate income. Let's pretend that beginning, the company just started operating. This is the first year of operation. So the first year, company earned $20 net income. But the shareholder, as soon as the shareholders find out, hey, that company makes money, we want some. So the only way they can get it is through dividend. Once you give them the dividend, you're reducing the retained earnings or the income that you're keeping in the company. If you give them $10 as a dividend, then You earn 20, give them 10. You're keeping 10 in the company. Why? Because it's the first year. I want to keep something from the earnings just in case. Second year of operation was more successful than the first year. Net income is $150. That net income is gonna go to the retained earnings, plus the $10 that you have from the first year in the retained earnings, and you earn another 150 from the income this year. Now you can give the shareholders maximum dividend of the total retained earnings, which is $10 from the previous years and $150 from the current year. So the maximum dividend in that case will be only $160. If you're smart, you're going to give them less. You're not going to wash out everything from the company. Let's move back to the slides. I believe there are a few more slides we have to cover before we go to the example. So for the solving the problems, we're going to use this template approach, which template approach is going to show the assets, which are equal to liability and equity. And under assets, we're going to have different categories, as you're going to see later. And under liability, different categories, and the shareholders' equity, different categories. On separate side, we're going to have revenue, expenses, and dividend declared. What we have to keep in mind, always have to keep in mind that every transaction must affect at least two accounts. Also, we always have to keep in balance the basic accounting equation. Means asset always have to be equal to liability and shareholders' equity. And the last thing that we have to satisfy is the retained earning will be affected only and only by income or revenue expenses and dividend declared, or the dividend that the shareholders has been paid. Now let's go over transaction one after another. Now I'm going to switch to the Excel spreadsheet, which you can find posted next to this recording, or as a part of this recording. So on the worksheet number 3, I'm going to start using the worksheet and I'm going to start going over transaction by transaction. First, this company, which is called Simple Company Limited, SCL, is formed as a corporation on January 1st. And once it's opened the company, they start transaction. First transaction that the company did was to issue common shares. Okay, let's issue those common shares. So once the company issue common shares to the investors, investors invest cash in the company. And they invest $250,000 cash. That means our cash is going to go up with $250,000 on one side, and common shares is going to increase with $250,000. So now we have $250,000 on the asset side, zero liability, equity goes up with $250,000. We're in balance. Now we can move to the next transaction. Second transaction, we're going to borrow now money from the bank. Usually bank give us a cash. So what's going to happen? Our cash is going to increase by 100,000. And now, since those are not investor, bank is a lender or creditor. Now we have obligation to pay the bank later on our loan. So we're going to create a bank loan payable, since we have the obligation to pay those money back, $100,000. Asset goes up with, or cash goes up with 100,000. Liability goes with 100,000. No changes in the equity. We're in balance. Those are the first two transactions that normally happen in the company. You have to understand, in order company to operate, the company needs the assets. And the assets can easily come either from the investors when they invest cash, or the lenders when the company borrowed the money. Now this company can start operating. Second transaction that the company did is to pay the rent. They have office, now they have to pay the rent. Let's copy those two and move it here and keep going with the transactions. The third transactions that we're going to see is the company pay rent in order to operate, which is a normal thing to do. Every company needs to pay the rent. So how are they going to pay the rent? Usually rent is pay cash. A landlord not going to let us stay in and operate in the facility if we don't pay them cash. So let's pay them cash. Third transactions, we're going to pay cash, which means once we pay the cash, we don't have the cash. We're going to reduce our cash $1,100. And our expenses, it's going to increase now with $1,100. That was the first expense as we start the company. Next thing that we have to do is to, for some reason, here we go, transaction number 3. The next thing that we have to do is to purchase equipment in order company to work. So let's purchase this equipment. What's going to happen? Once we purchase the equipment, we're going to have equipment. So we're going to increase the equipment with 65,000 on transaction number 4. But somehow we have to do some exchange for that equipment. What will be that exchange for us? That exchange will be for cash. So basically, we're converting cash into the equipment. So our cash is going to go down with 65,000. And equipment goes up with 65,000. So what's the effect here? The effect is only on the asset side. We transfer one asset into another asset. There's no implication on the liability, no implication on the equity. That's how we keep equation in balance. And that's transactions 3 and transaction 4. Now let's copy those one and move to transaction 5, 6, and 7. In transaction 5, the company purchased 1-year insurance policy for $1,800 cash. So technically, basically what's happened, the company paid $1,800 cash. What company received? Company received insurance for 1 year ahead, going forward. Now the question is the year already passed? Or in January, we're purchasing insurance from January to December for the whole year. Did we use any of the insurance? The answer is no. So since we haven't used anything of the insurance, that doesn't represent expense for us yet. For that reason, we're going to keep it as a prepaid expense or prepaid insurance. The other reason for that is that we can order, and at any point we can decide to cancel that insurance, and then the insurance company have to pay us the money back. So $1,800, our prepaid expenses is going to increase. Prepaid expenses is an asset account. Please remember it. Prepaid expenses is an asset account. Why? Because it represents obligation of some other company to pay us money back. So we can have the rights to go and ask the other company for which we paid something that we haven't used yet to pay us money back. So as you can see here, again, one asset converts to another asset. There's no implication on liability, no implication on the equity section. Let's keep going and see how everything's gonna flow. Transaction number 6. Company purchased land for $180,000. At this point, we're going to check, do we have enough cash to purchase land for $180,000? And at this point, we have $2,802, $100 cash. So yes, we do have the cash. So let's purchase that land. So we're going to pay cash, $180,000 cash gone, but now we have long-term asset, $180,000 left. Again, this transaction affects only the asset side of the equation. It doesn't affect the liability or equity section. One asset is converted to another asset. The seventh transaction, account transaction number 7. In that transaction, company purchased $23,000 inventory on account. One thing that I want to point out here is every time when you see somebody purchase on account, means that company doesn't pay cash. Well, then you're going to ask me, well, if I don't pay cash, how can I get it? Well, you can get it on credit. For the time being, that will be a liability for you until you pay it. So you're going to create accounts payable. So we purchased the inventory. Let's increase our inventory with 23,000. And we're going to increase now our accounts payable. Why? Because later on we have to pay this supplier $23,000. So this transaction affects the asset side of the equation and the liability side of the equation. Asset is equal to the liability. There's nothing on the equity, so we in balance, everything is perfect. And that concludes the transaction 5, 6, and 7. Remember this, purchasing on account. Every time when you see on account, that means on accounts payable. So you're not paying cash right at this moment, but you still have to pay cash at some point in the future. So that becomes liability for the company. Let's copy those 7 lines and flip it to the next screen and keep going. So far we have those 7 transactions. I can easily erase those lines. That too many. I don't need those ones. So let's see what's happened in transaction number 8. In transaction number 8, company sold the product to the customer. And the customer pays cash, 21,000. And the remaining has obligation to pay us in the future, stays on account. Again, what means an account? That means the cash hasn't been exchanged yet. And since we're selling now, and somebody else doesn't pay us, for us, that will be receivable, because later on we have to receive the difference between $34,000 and $21,000. So let's do the transaction. Transaction number 8. So our revenue, finally we have something on the revenue. Revenue is going to exceed. Increase with 34,000. Revenue increased with 34,000. What's happened on the other side? There is no liability here. In the contrary, we have asset. We have $21,000 increase in cash. And since here we have 34 and 21, we are not in balance. We have to balance it, those $13,000 that we are different, with some other account. What will be that account? That will be accounts receivables. Why? Because the client later is going to pay us those $13,000. Once we put the 13,000, now we end balance. 34 here versus 34 here, we are perfect. Now we can move to the next transaction. Now, what I want you to pay attention is every time when you sell something, when you have a revenue, At the same time, especially when you're selling the inventory, at the same time, you have to reduce your inventory. Because once you sell your inventory, or once you sell your goods, you don't have them yet. You don't have them anymore. So since you don't have it, you have to deduct it from your account. Which account will be that? From the inventory account, obviously. So for that reason, now we have to reduce the inventory account. The question is with how much? That will be with the cost that we purchase the inventory. We're not going to reduce it with the amount that we earn. We're going to reduce it with the cost. And then we're going to see how much money we made. So inventory goes down with $17,000 because we don't have it. The client has it. And that will be direct expense, or more specifically, cost of goods sold, 17,000. Now, at this point, since we have both transactions, revenue and expense from the same item that we purchased before and now we're selling for the higher price, we can right away see how much profit we generate. And we're generating $17,000. Why? Because whatever cost us $17,000, we sold it for $34,000. Always remember, every time when you go to the grocery store, grab a jug of milk, go on the cashier line, and the machine beep, say beep. In that point, two transactions happen. First transaction is to increase the revenue and show the cash, which you're going to pay. And the second transaction is to reduce the inventory, since that milk from the store moved to your hands, and to show the cost, which is going to match the revenue. So they can see directly how much profit they're making from selling that milk. Transaction number 9. Now the company received $11,000 payment from the customer for the sales that was just made on the account. So the customer decide to pay us. Thank you very much, customer. Let's get it. Let's get this 11,000 cash, and we're gonna reduce the customer's account. So the customer now owes us only $2,000. This transaction affects only asset side, as you can see. No effect on the liability, no effect on the equity side. So let's copy those lines, 1 to 9, and move to the next transactions. I'm gonna erase those lines here and keep going. Transaction number 10. Now, in transaction number 10, company makes payment to supplier for the inventory that we previously purchased. So what we can do, we can go back and check where we purchase inventory. We purchased transaction number 7, we purchased inventory. But guess what? We didn't pay. How much we didn't pay? 23. Now we're gonna pay 13,500. So let's pay them. Number 10, how are we gonna pay them? Obviously, we're gonna pay them cash. Once we pay the cash, we don't have the cash. So let's reduce the cash with 13,500. And also let's reduce our accounts payable with 13,500. So now, as you can see, we have only 9,500 left to pay for this inventory that we purchased in transaction number 7. This transaction, as you can see, reduces the asset on one side and reduces the liability on the other side. Everything is in balance, so we don't have to worry about it. Next transaction. Now the company pay utility costs for $1,900. So let's pay those one. 11 transaction 11. Once we pay them, we're gonna reduce the cash with $1,900. And since we pay for something that we already used, that's gonna reduce our increase our expenses. So 1,900 will be our expense for utilities. In next transaction, transaction number 12, The company paid advertising cost for the month. So whatever cost us for the advertising, we paying it right now, $2,200. Let's pay those $2,200 and let's think for what we use those one for advertising. Is that related to our operation? Yes, it is related to our operation. Is it liability? No, it's not because we're paying. Is it equity? No, it's not investment for the shareholder. So what is it? It's pure expense. So let's go to the expenses and just expense $2,200 at this point. And that concludes transaction 10, 11, and 12. Now I'm going to copy those lines and I'm going to move to the next worksheet. In the next worksheet, we're going to do with the transaction 13, 14, and 15. First, with transaction 13, we have to pay our employees for the month of January. At the end of the January, it's good to pay our employees. So let's pay them. Employees usually, they work for cash. So let's pay them cash. 2,900. And since they provide services for us, for the operation of the company, that will be direct expense. And we're going to increase the expenses with $2,900. And that completes the payment of the salaries. Next transaction, the owner of the company feels that, hey, company might making money at this point. Let's get some cash from the company. So they ask, hey, pay us dividend. And we say, okay, let's give you some dividend. And they want only cash. So let's pay them cash. Minus 400 cash. And the dividend paid is going to increase with 400. Next transaction, that equipment that we purchased back in transaction number 4. Now, that equipment, we start using it on the daily operation of the company. Since we're using it in the daily operation of the company, and that equipment produce value and revenue for the company, then we have to transfer some of the cost of that machine as an expense. So over the time when we're using the machine, the value of the machine is going to start going down. Why? Because we're going to start transferring the value from the machine into the expenses as a depreciation. How are we going to calculate the depreciation? For the calculation of depreciation on sheet number 9, we're going to see we need a few things. In order to have this calculation, we need the original cost of the machine, which was $65,000, and we need the residual value. Residual value is related to something that we can recover from the machine at the end of the useful life of the machine. So in this case, we estimated that after usage, we stop using the machine, we can sell the machine and we can get, based on the market, $3,800. Since we can get those money back from them once we sell the machine, we don't have to depreciate those amount. So how much are we going to depreciate? Only the original cost minus the money that we can recover once we sell the machine. So we can depreciate, we have to depreciate only $61,200. Based on what? Based on the usage of the machine. And we're going to use the machine for 6 years. That means we have to depreciate $10,200 every year. But since we're reporting month by month, we're going to transfer this amount by month. So every month we have to depreciate $8,500. So since we have the amount, $8,500, let's show it as a transaction. Transaction number 15 will be, we're going to reduce the value of the equipment with $8,500, and we're going to increase our expenses with $8,500. And we're done with this transaction. Let's copy these lines and move to the last transactions 6, 7, and 18 if there's 18. second. So now we have all the transaction 1 to 15. The last two transactions that left is 16 and 17. Let's see what's happening in transaction number 16. Now, the insurance that we paid in transaction 5, since 1 month already passed, we have to transfer some of the insurance related to January into expenses and reduce our prepaid expenses. So in transaction number 16, that's exactly what we're gonna do. We're gonna calculate first, out of the amount of 1,800 divided by 12 months, how much we have to transfer every month from the prepaid expenses into the expenses. And we calculated $150. So let's reduce the $150 from prepaid expenses and move it directly to the expenses to increase those expenses $150. And we're done. The last transaction, 17, is related to bank loan. Bank wants money. Since we borrow from the bank and they want interest, we have to pay them interest. So, but since we're not paying interest cash right now, so we're going to increase our interest payables with $500. And at the same time, we're going to increase our expenses with $500. And that's the last transaction for the month of January. Now let's see what's happened with this company. This company, after all the transactions, once we do the calculations for all the assets one by one, we're going to find out that in the company right now, we have, that's not the correct amount. Let's change the formula, see exactly how, from where the formula reads. We have exactly $13,200. We have 2,000 accounts receivables. We have inventory for $6,000. We have prepaid expenses left, 1,650. We have equipment for $64,150, and we have land for $180,000. In total, we have assets for $367,000. Let's say how much is our liabilities. Our liabilities, we have to change that formula. Our liabilities, we owe $9,500 to the supplier for the inventory that we haven't paid yet. We owe to the bank $500 as an interest and $100,000 as a principal on the loan. Common shares. Change the formula again to include all the transactions. We have common shares for $250,000. We don't have retained earnings yet, and we don't have, so for the revenue expenses, we can easily calculate and we can see that we have a revenue for $34,000, expenses for $26,600. That gives us net income of $7,400. Of that net income, $400 was withdrawn from the owners as a dividend. So the retained earnings that stays in the company at the end of January is for $7,000. Total liability and equity is equal to $367,000, which is exactly the amount of the assets. As you can see, we are always in balance. That's what I want you to do when you're doing the exercises. Keep everything in the balance. Always show the effect on the two accounts. And keep basic accounting equations always in balance. Means asset to be always equal to liability plus equity. That's the whole question from the slides. now we can move to the slides directly and finish those slides. What's left on the slides? Those are the transactions: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, explanation about depreciation, 15, explanation about the prepaid expenses, 16, 17, and that's about it. So basically, they show you the Excel spreadsheet, which we just prepared. And as you can see on our Excel sales spreadsheet, we can see that we have retained earnings at $7,000 at the end of the period. Accounting equation template. The major limitation here is the number of the columns and the lack information regarding the revenue, expenses, dividend account. But the way I did it, you have that information as well. The way they're presenting it, it's not that obvious. So keep with my Excel spreadsheet that I'm going to post you. That will keep it simple. Now, what next thing that we have to do is, based on the Excel spreadsheet, we have to prepare financial statements. First statement that we have to prepare is the income statement. This is the easiest one. So we have to, what we have to do? We have to get the revenue, sales revenue, deduct cost of goods sold, show the gross margin, and then deduct all the rest of the expenses. And as you can see, our net income is exactly a net income that we saw in the Excel spreadsheet, $7,400. Next thing that we have to do is to show what's happened with the equity. The balances in the January was all zeros. So what happened? During the period, company earned $7,400. That's a retained earning. Also, company declared dividend, $400. Remember, dividend is not part of the expenses. Dividend is part of the equity or retained earnings. Don't forget that. We give the shareholders $400 as a dividend. And the last thing that happened is we issued 10,000 shares for $250,000. So our equity is $257,000. After we complete this, we have to do the balance sheet or statement of financial positions. So we have to see how much is our cash, how much is our receivables, inventory, prepaid, insurance. That shows our current assets. Then we're going to have our equipment and land. That will be our long-term assets or non-current assets. Total assets, $367,000, as we saw in the Excel spreadsheet. That's with the assets. So now let's see from where we get, from where those assets came from. Those assets came from short-term liability, $10,000, and long-term liability, $100,000 from the bank. So from the liability, $110,000 from the assets come from the liability. The rest are from the investors, and $7,000 are from the income that we generate during the month of January. Total, 367, which is exactly equal to our assets, 367. Next thing that we have to prepare is the statement of the cash flow. For the statement of cash flow, we're not going to go deep because that's too much. Now, the only thing that I want you to remember here is we're going to have this operating activity, investing activity, financing activity. Operating activity is always related to current assets and current liability or working capital. Investing activity are related to the long-term assets, and the financing activity are related to the long-term liability and equity section. Now, profit ratios. Ratios are important. We're going to spend more time on the ratios later on, I believe, on the fourth lecture. What we can draw from here, see how much is the net income. Net income is how much is our profit ratio. Profit ratio is always net income divided by the total sales, or $7,400 divided by $34,000 revenue. Or this company generated 21% profit ratio. Next thing that we can see is how much is the return on equity. Basically, how much the owners, how much is the owner's return? They invested initially $250,000 and $7,000 came from the retained earnings, but the total earnings was $7,400. Net income is $7,400. In other words, the return on equity is almost 3%. The last thing is return on assets. From the assets that we have, how much we get? From 367,000 assets that we have, we generating only $7,400, or our return on assets is 2%. And that concludes chapter 2. At this point, I'm going to stop the recording. Please refer. I'm going to pause this recording in the Brightspace, along with the Excel spreadsheet. Also, I'm going to send you email with the link to the recordings plus the Excel spreadsheets. Thank you for your time and have a great day.